Um, Thanks everyone for joining. I'm sure we're gonna have a lot more people trickling in throughout the session, but I wanted to get started. As always, we have tons to cover, a lot to jump into, and I'm just excited to talk to you all. I'm gonna come off screen share for a second just to see who we have here. Kesser, I wonder if Kesser's back from Kuwait, and Faye has got a nice tropical background. Look, we have a lot of different variations of the workshops that I teach, but there's one topic in particular that comes up in random questions and messages that get sent and frustrated emails about passes that end with not sure that this is venture backable, which is why we developed this variation of my main workshop so that we could double click on this and help founders understand what's necessary and what's in front of them. So this is actually going to be a series of workshops where we'll do deep dives and have guests in different industries. And this first one, as you hopefully all know, is around SaaS. So this is the Are You Venture-Backable workshop series, Are You VCB SaaS edition. If you guys are in the wrong place, feel free to leave now. It won't hurt my feelings too much. And we'll talk about it a little bit later, but we have a really special guest. We're excited to have him. It's hard to nail down these VCs to talk to you with their guard down, but I think we have one that will do it with us. So let's start with housekeeping for my workshop. So it was like starting here, please put your cameras on. My workshops are very interactive, and if I can't see how you guys are reacting to what I say, I don't know if I'm confusing you or if you're bored. I'll probably look you in the eye and cold call you, Fernando, and ask you about what's going on. So I'm glad your camera's on. The Zoom chat is open. Zoom is one of the most active and fun places in these workshops. People share information, ask questions, and my team is going to be monitoring it just in case there's anything that I need to jump into. So throw in Q&A there. If it's important enough to interrupt the workshop, we will, but we also have some time at the end. Share any insights you have on social. This is not meant to be a private group. We're trying to help the community. We're trying to make sure that everyone learns. So if there's anything that you see, share it on social, tag us. We'd love to amplify those messages, amplify you all. And then the last thing to know is that these workshops, like I said, are very interactive. So if I ask a question, the founders that raise their hand and interact with me will likely get the most out of these workshops. So don't be scared. And on top of that, if I do ask questions and people decide not to volunteer, I'm not scared of cold calling you all. So you guys have jumped into the hot seat essentially by joining my workshop. But like I said, even if you don't volunteer and you're talking to me, you're probably going to get the most out of it. I've started to encourage people during these sessions to think about the value of simulation as well. So let's say you don't volunteer and let's say you don't get called on, but the question gets asked. I'd highly recommend you think to yourself, well, if I, Tariq, got asked that same question, what would I say? How would I answer it, right? Like, you want to get the most out of this value, out of this workshop. Let's try not to make it edutainment. Let's try to make it actually practical. So when we go through these questions, simulate it yourself and see how you would answer. Before we jump into this, just to be prepped for some of the stuff that we're going to be doing, start thinking about your business now, because I'm going to be asking questions, simple things like, what is your business? What is your business model? What do you sell? How do you execute? How do you monetize? These are the inputs that we'll use to get a little bit more learning around, are you venture backable or not? Okay. I see a lot of familiar faces. Hey, Rob, hopefully Philadelphia is nice and warm. So some of this will be stuff that you have heard, but I think for the people that haven't been with me for a workshop, it's important to hear some of this context. So my name is Jason Ye. Some of my background, I started my career in tech. I was the head of new media products at MLB.com. I was a venture capitalist at Graycroft. I started a couple companies. The last one was a SaaS company called Tape. which we raised a couple $1 million for and had a small exit in 2020. After that, shifted over to this line of work, starting with being Silicon Valley Bank's internal fundraising coach before peeling off to do this myself. So my company is called Adamant, focused on making fundraising as easy as possible and as accessible as possible for as many founders as possible, because I believe that it's the driving force of that economic development around the world. And it's my favorite type of people, which is why I like working with y'all. We do that in a lot of different ways: podcasts, workshops like this, newsletters. Would love for you to discover me on all those platforms. But I actually don't give this background in order to credential myself or to promote my podcast. It's really to give you guys context for the advice I'm about to give you. I like starting with this speech because I think it's important for all people to understand what advice is and what it isn't, especially in this day and age where you all are, I'm sure, following a bunch of venture capitalists and thought boys on Twitter and LinkedIn, and they deliver a lot of sound-bitey advice. Even I do on Twitter. But it's your responsibility to dig deeper and to understand first principles, understand the context with which people are giving you advice so that you can understand it more deeply for yourself and be strategic and creative when problem solving yourself. And the example I give around this and why context is so important, especially in this game, is that you really, on almost any topic of advice, but in particular, startups and fundraising, you could find two equally credible people that will give you 180-degree opposite pieces of advice. So here's a great example. This is on the topic of data rooms and whether or not founders should share data rooms, when they should share data rooms. Andrea Funston on the left talks about how it's one of her favorite signals, and she really believes that the moment you meet an investor as a founder, share your data room right away, and the investor will get really excited and lean in. Whereas Mark Suster, partner at Upfront Ventures on the right, essentially in this essay says that founders should never share their data rooms, which is confusing for founders, especially when you read these things as sound bites. And so the call out here is that if these two investors sat down and broke bread, they would probably agree on a lot of the same principles. It's just the way it's being communicated. So think about that. The context for which I give you advice is meant to be, well, do I believe in the background that Jason has? Does it feel familiar to me? Do I want to listen to what he has to say? But ask questions of me, ask questions of other people that give you advice. Okay. So let's jump into the idea of our focus today, which is, are you venture backable? First of all, let's come off screen share and start interacting with y'all. Some of you have probably heard the idea of, Gustavo, I'm sorry, man. I just don't think your idea is venture backable. Yeah. I don't know what to say. And then a lot of founders hear that and they don't know what that means, or don't even know what that means in terms of what they should do. So what does that mean to you all? If anyone has any ideas, maybe throw it in the chat. I might, if you want to volunteer and raise your hand, I'd love to talk to you. Brian, means you haven't told a good enough story. Okay. Meaningful market cap. Great. And honestly, Jonathan, so Mark Mullen is in the room. Jonathan, if you want to ask Mark if he wants to join just to listen in, I'm happy to have him. Okay, so let's see. I'm looking at all these answers. This is great. So Isabella, I'm going to call on you and ask you, what do you think it means to be venture backable? What does that mean to you?
Hi, everyone.
Well, first of all, where are you joining from?
From Munich, Germany.
Oh, very nice. Wow.
So
So what is the question, are you venture backable, mean to you?
Yeah, I've thought about this a lot, or it has come across me a lot. That's why I'm in this call or in this event. Thanks for hosting, for sure. Yeah, so I think it means, for many people, it means different kinds of things also. So what I hear a lot, that's what I put in my answer here in the chat about defensibility. So something that sets you apart from others, that they cannot copy or cannot do as good as you. And that often, for some, it's really important that that's like technological. So maybe you have an algorithm that learns, and it's hard for others to copy that. Like it's a time-based thing, you're advanced in that. Or you have some skill set in your team that others cannot build up as quickly as you, or some experience that others can't. Yeah, so I think that's my main take for now, at least.
That's good. You're hitting on a couple things, defensibility and uniqueness, which play into this a little bit. There's a lot else out there besides that. Is there anything specific that's confusing to you? Like you hear, are you venture backable? And you're like, I don't understand that. I see this and they got venture back, but it also doesn't see, they don't have this. Are there any quick questions that come up from that?
Yes, maybe. So one thing, venture backable, when they tell you, yeah, so it means that the VC, want to invest in that thing that is more like it's more likely to fail, or the idea is more likely to fail. But if it doesn't, then it's like the mega thing. And are you the right ones to execute that? And then I look around and I look at all these businesses and I'm like, like, I'm not so impressed by what are they, like that one thing that will, I don't know, like, how do you say, reign the world or be the next Google, not sure, but they still got venture money. So I think that's confusing in a way.
Very good. Yes. So there are investments that you see out there that kind of don't fit the profile that you think people say that is important for venture backable. It's like, is this unique enough? So, and we'll talk a little bit about this idea of like, wait, what about these exceptions or these things that you see, and why do they do the deal? In fact, we'll probably ask Mark a little bit about that. But Isabella, thanks for coming up on stage to talk about this. So she mentioned a couple of things that I think are important. And it leads into the first thing that I wanted to share before we get into like really basic level descriptions of the idea of venture backable. One thing that I want to make sure that you all do not confuse is that if something is not venture backable, it doesn't mean it's a bad business. And this is maybe the most important thing and the most important reason for this workshop to exist is that as people think about ideas that they want to run, they're like, ooh, raising venture capital, starting a business, raising from VCs. And then they look for validation from the venture capital market of whether or not they're doing the right thing. And it's incredibly important to realize that you can be running a good business. You can be running a fantastic business, an amazing business, in fact. I would say that I'm running an incredible business, but I am not a venture backable company. And so let's talk, we'll jump into this because I want to make sure that if people are going into these workshops and they're doing the math and they go through the exercises with me, on the other side of it, if the answer is not venture backable, like it just means you have your, Faye is a brunette versus a blonde. Jacob has curly hair versus straight hair. It's just a characteristic of your business, and it doesn't mean anything in terms of your prospects for success or failure. It's just a different way to run your business. Okay, so that's the very first thing I want to make sure people take away from this. Here's a slide that I like putting out there just to describe the basics of VC portfolio theory and how they run their companies. So VC is a company itself, and it has to make money. The way it works is, and this is oversimplification, especially if there are any VCs in the room like Mark, so don't jump down my throat. But the idea is that a VC is going to be investing in super risky businesses that have the opportunity to be an outlier. And when you invest into super risky businesses at the earliest stages, there is a huge chance that it goes to zero. Now, the investment strategy is to bet on the similar thing over and over again, knowing that most of them will go to zero, but knowing that you're investing in companies that have the potential of being gigantic, so that if it does hit, if it does become successful, then the profits, the winnings, the success of that one or few outliers covers all of the losses. And when it covers all of the losses, then that margin between the losses and the profit that you got from one or two successful investments is how VCs make money. The important thing to note here is that Ryan might have a great business, might even be a huge business, but if it's not the potential of being a gigantic business, then if I slot him into my investment portfolio and it hits, then I've used one of my investment slugs, bullets, if you will, on something that even when it hits, it doesn't fit the business model. Like he might exit for $100 million, which is life-changing for Ryan, life-changing for most people, but actually is a non-successful investment in my portfolio. Like I've used one of my investment slugs, my checks on him, spent a ton of time working with him throughout the whole thing. And by the end of it, he was as successful as he could have been, and it still didn't make my portfolio work. So this is the basics of VC portfolio theory, which drive the idea of, are you venture backable? Are you running a business big enough where if I squint and I see the future for Cameron, it's like, will this be massive? Can this cover, can her outcome become that winner that covers and becomes a fund returner is the term they use. So when we think about oversimplification of, are you venture backable and can you get this done? We're talking about two things. We're talking about, one, are they even working in a space, in a business, in an opportunity that has massive potential? You know, can I believe that this could be a multi-billion-dollar business in 5, 10, 15 years? So if I check that box, then I'll move on to thinking, okay, like at least they're pointed in the right direction. Now, can Dimitri actually get this done? Do I think that Dimitri has what it takes or understands what it means to run a big business? And is he going to be excited to do that? So those are the two things that we want to make sure as investors that we check the boxes on. And in this session, what I want to focus on is the first, because you all have listened to me talk about portfolio theory. I saw what you what you put in the chat. Patty said fast growth expectations. Fernando, big addressable market. You're saying all the right things. You are, and some of you have done it because you've read online, you've talked to people. But what I find when I talk to founders, especially first-time founders, if I were to really, really test Brian and ask Brian, what does that mean to you? Like, tell me more. It becomes a little bit shaky. And so I want to make sure people understand this so that when they think about what is necessary for me to communicate to a VC, if you still want to go down this path, they understand what they can actually get done. Okay, so some of you may not love this. We're going to go back to basic math, some basic math. So a lot of this is math. It's, do you have what it takes, Rook, to become a multi-billion-dollar company? And do you even know what it means to be a multi-billion-dollar company, how we even get to that? So the first thing we're going to talk about when we say, do you have massive potential, is to say, what stage company are you? Because when we looked at that graph of that outcome chart for the VC portfolios, VCs are underwriting, are estimating, if you will, what they think the company could become. So if Basil is a pre-seed company, when I invest in Basil, I'm like, I have to believe the VC expectation on a return is, I have to believe that there is a possibility that this will be 100x. And when Sandeep comes to raise money for his Series A, I still have to believe there's 10x growth in whatever he decides or we decide the valuation should be. So the very first thing we're talking about is, what is the VC return multiple? What is the VC return expectation for your company at your stage? These are ranges, a bit finger in the air, but directionally accurate. We'll use these as we go on. So from here, it's like, okay, let's get to what investors need to believe in order to see the math working. The first thing I'll walk through is just the simple math of, what is your target exit value? Well, if Patricia thinks that she should raise at a $15 million valuation, then, and she's a pre-seed or seed stage company, based on the VC return multiples, what should her target exit value be? Does anyone know? Let me throw it in the chat. Who likes math? So $15 million is her valuation. She's a pre-seed or seed stage company. Now, in case you didn't see it, the expected underwriting model is 100x. There we go. $1.5 billion exit for Patricia. Patricia, sorry, you're just going to get cold called since I saw your name in the corner. Do you want to come off mute for a second and chat with me?
Yeah, I think it's me, right? Because there are two.
Oh, well.
Oh, that's another one?
No, whoever's talking is good. Let me just, Jonathan, you can spotlight her. There we go. Where in the world are you, Patricia?
I live in New York, but I'm calling from Madrid today.
Very fun. Okay.
Yeah.
So you're going out to raise. You think you can get a $15 million valuation as a pre-seed and seed stage company. Now, in the chat, Jacob, Kevin, Solo, everyone properly did the math and said that means a VC needs to believe that when you exit, you're going to be worth $1.5 billion. Do you know how people, companies, firms, etc., do that final valuation, that $1.5 billion? Do you know how that gets done?
Well, I guess it depends on the type of company, but I mean, applying the multiples to the, or at least this is, how I see it, but applying to the multiples to the KPI that corresponds to your business. So in some cases, it can be valuation over, well, AV over EBITDA, otherwise other times over revenue. So it depends on the sector, but it's based on multiples, based on your expected revenue projections or P&L projections, pretty much.
Very good. You should.
That's what I think.
Be on this side of the table. Did you work in finance before?
Yeah, I was in banking.
I expected. Very good. I didn't do that on purpose, but that makes things. Let's dive a little bit deeper, because a lot of the people on this call weren't in banking. So we will be talking about valuation multiples. But what is a value? Like, why do firms use valuation multiples? It's a shortcut, right? Like what is baked into the idea of a valuation multiple?
Well, you may get neither, but basically is a way to compare companies that are like, from the same sector. Obviously, there are like different things that come into play whenever you value a company. It can be like the revenue, whether they have debt or loans, etc. But if you're getting companies from the same sector, you want to make sure that you value them on a same basis, right? On a comparable basis. So many times, whoever is valuing, whether that is VC or a bank, etc., they go to multiples in order to compare companies side by side.
Very good. And this is not meant to be a gotcha. It's really meant to have people hear from different voices, because I find that learning is really hard to do when you hear from one voice. Like, humans are naturally skeptical. So if people hear from another expert, like someone who used to be in banking, I think it's helpful. So I appreciate you jumping in. Totally. I mean, I agree with you. I've never been an investment banker, so I wouldn't call myself an expert. Mark Mullen Exactly though. He'll be joining us soon. So yes, I think firms and people that need to value companies use multiples in order to slot people into similar stage companies, similar style, similar industry companies. But to me, it's really a shortcut to say, we're trying to figure out what the full value of a company is at the end state. And we could look at what their margins are. We could look at their growth rate. We could look at like what the future industry prospects are. We could do a bunch of different calculations, but valuation multiples are a shortcut to say, a lot of people have done it for SaaS, and we think it's 10x revenues, essentially. So it allows people to do this valuation calculation very easily. So what we want to talk about then is, once we have the exit value, we're going to be using valuation multiples in order to figure out what your revenue size needs to be in this hypothetical world in the future when you exit for $1.5 billion. There are some multiples out here. And by the way, multiples change all the time based on market conditions. But it's kind of rule of thumb right now is that people will use 10x for SaaS. That's like actually going down and down and down as the market goes worse and worse and worse. Some people have been valuing SaaS at 20, 30x in past years, but some multiples we can use are 10x for SaaS, 2 to 3x for retail commerce, 2 to 3x for media stage companies. So why is this important? Well, we need to have you guys calculate how much revenue do you need in order to get to that point in the future, to get to a $1.5 billion exit. Okay. So start thinking about all of that. What if you guys ran this simulation for yourself? What valuation do you want to raise at? What stage company are you? So what value do you have to be? And then divide it by the revenue multiple that is particular to your type of company. And if I didn't list it in there, put 5, put 10x there to understand what revenue you have to have at exit. The next thing I want to do is talk to, let's see, who have I not spoken to? Rook. I saw your name before and I like the name. Are you still there? Maybe not. David Bettenhausen. How are you, man?
Well, how are you?
Good. Where in the world are you?
I'm in Dallas, Texas.
Very good. Have you done the first couple steps of this exercise?
Yes, been following along.
Okay, great. So can you tell us what you would like to raise at? What valuation? And no one's going to hold you to it, so you can throw out any number.
What I would like to raise at in what scenario? In this pre-seed?
And in the round that you want to raise next, what do you think the valuation of your company is going to be?
10, ideal.
Awesome.
Yep.
And it's a pre-seed. So
yep.
we think that it needs to exit for
billion.
And what kind of company is your company?
SaaS.
It's a SaaS company. Great. So we're going to use a 10x multiple. And with the 10x multiple, what does that revenue need to be at the exit?
100 million.
100 million annual revenue. Okay. So the next stage of this is to say, what is your business model for this, or what is your pricing for SaaS, your SaaS tool?
Around 120K or 10K per month, 120K a year.
Oh, okay, cool. So it's an enterprise. It's
yeah.
High. So 10K. So let's just do $100,000 a year, right? So how many customers are you going to need by the time you exit in order to get to that?
1,000, something like that, right?
1,000.
Yeah.
10,000.
10,000. Yep.
Yeah. 10,000. 10,000 enterprise customers paying you every year, right? So this is where we get everyone to think about exactly like what is possible. You know, what type of customer are you going after?
These are commercial airlines and their third-party repair vendors, as well as OEMs.
This is really interesting, right? The market that David described sounds actually pretty niche, right? Like how many of those exist in the world, if not the United States?
Yeah, so it's good because you can actually check on publicly available databases like FAA as well as EASA in Europe. And so from a repair station network, there's around 5,000 approved in the US alone. And so I would say too, our model is based on facilities, not customers. So a customer could have 30 facilities because a lot of these are large conglomerates. And so there's around, yeah, like I said, 5,000 in the US, globally around 18,000. And that's what we're looking at.
So this is not meant to be an indictment of David's business or even like prove to me some like question and answer. It's meant to be the mental exercise that you all have to go through to be like, well, what does this have to be, right? Like, and his initial market that he's described, essentially, he has to have twice as many customers as exist in the United States, which like, we can talk a little bit about what it means to evolve and, you know, how companies add on product lines, et cetera. But just so you all know, when you think about the end state, it's got to be big, and you have to be able to convince someone that either you know what you're doing and what the direction has to be, or that David just has it in his eye that he wants to run a big business. And he's starting with a company that maybe, or a focus that might not on its own be the $100 million of revenue, but that there's so much else around that could, you know, be added on, evolved, et cetera, in order to get to that. David, thanks for going through that. Sounds very interesting. But what I want to just say before we get into talking to Mark, because Mark is here, is that a lot of this creativity, a lot of this thinking that you all need to be doing is whether or not you actually are running a venture-backable business, whether or not you actually want to run a venture-backable business, like get to that kind of scale that you have that much craziness in your eyes around the problem that you're trying to solve, the industry that you're in, that you can convince yourself and you can convince investors that you want to be in it to build the biggest possible business possible, you know? So the thing that I would say is, if the answer is no, like there's no harm, no foul. There's no scarlet letter associated with running an awesome non-venture backable business. It's one of the coolest things you can do. Honestly, it is really, really cool. So this is more to be like, think about what this is, think about the path that you want to go down so that you can psych yourself up and really get investors to be on your side around the fact that you are going to be the one to take it to the promised land. So we are going to actually now try to hear from an expert, someone who does this himself. I've just let Mark Mullen in. And before I actually bring him on stage, I'll tell you a little bit about Mark. Mark is managing director and founder of Bonfire Ventures. Let's see, let's bring up his pretty glamour shot here. Mark is one of the premier SaaS investors in the country. He's had mega outcomes like the Trade Desk, which IPO'd, Edgecast, huge outcome to Verizon, and just one of the most respected investors from both sides of the table that you'll meet. VCs love working with him, sharing deal flow with him, and his founders think he is founder first and is essentially a straight shooter, which is hard to find in the venture capital. On top of that, Mark is a close friend of mine. He, you know, when I first got into the venture community 10 years ago, most VCs wouldn't give me the time of day for whatever reason. Mark spent time with me and really helped develop my career. So I appreciate him. We're going to bring him on stage now. Mark, how are you, man?
Good. How are you?
Very good. We have a great group of founders, all dying to hear what you have to say. But before we get into it, I did that bad job of introducing you, but I want to make sure that you have like 10 seconds to describe Bonfire. one of my favorite firms out there, and a firm that I think all these people should know about. So if you could just, 30 seconds on what Bonfire is,
Sure.
focus, be good to give context for what you're about to say.
Sure. Well, thanks, Jason. I remember meeting you 10 years ago, whenever that was. I had a prior career. I was an investment banker for 20 years, folks, and worked for an incredible entrepreneur himself, who was known as the father of cable TV. And so I learned from an incredible entrepreneur as well as an incredible person. And one of the things we were very focused on was respect for everybody, no matter what position. And I knew Jason was like 23 when I met him, and he was 25 when I met him, and he was trying to grind through at Graycroft. And I dug his gear and his hair, and I thought he was super smart. So it was great to get to know him. But I always try and communicate with and learn from as many people as I can, particularly people who are younger than me and from different education background, wherever. And so Jason's a great person, as you know, so it was great to hang out with him. But Bonfire, which is now 7 years old, is a continuation of the funds that I started in 2012 called Double M Partners. And my partner, Jim Andelman, started a fund called Rincon Venture Partners. And we were both coincidentally focused on seed stage investing, primarily in Southern California, and for only B2B software. And that turned out to be a lucky kind of prescient focus. We weren't and aren't very good at understanding, for example, platforms that focus on consumers. Nothing against it, of course, but I just don't feel comfortable with my own expertise in feeling like I can make a judgment on a potential investment in consumer. We felt that like the cloud and mobile were going to be huge growth areas, which they turned out to be. We weren't the only people that thought that. Actually, if you looked at my deck in 2012, it said it was going to focus on the cloud and on mobile, which is kind of hilarious. You would not say that today because everything is in the cloud or on mobile. So we've really honed our sector, our focus to, again, lead seed rounds for B2B software companies. We only do 8 to 10 deals a year. We now have a team of 10. And we tend to write $2 to $3 million checks in the first check that we write. We maintain about 60% of our fund for follow-on. So we do like to follow on heavily into the A, depending on the circumstances, and maybe a little bit in the B, but we really like to get involved in the A. Of the 10 deals we do a year, 9 we lead, and 9 we take the board seat. And the reason there's always 1 or so that's left is because we end up sharing a deal with someone that we know and trust, who will actually do the work and take the board seat, and someone that we learn from as well. So we do our own due diligence. We do like to own the largest piece of the seed round. We do not do pre-revenue. In fairness, we have done pre-revenue in the past on occasion with former founders that we've backed in the past. So we kind of already have a known quantity. But in today's environment, with so many companies attempting to, every time a new deal opportunity comes to us, all I have to do is Google what they do, and I have 7 competitors, right? And so now we have to really dig deep and try to understand, is this the founder team that is going to be the winning team? And it really comes down to your go-to-market strategy and your efficiency in going to market. And I can't tell how good your go-to-market strategy is if you have no customers already. So we're very focused on being that seed layer after there's been some traction developed, whether it's a pre-seed investor that's backed you or not, or you've done it yourselves. We need to see traction, and we need to have a conversation with those customers. And we really need to understand, from those customers, we call it customer love. If I get on the phone with one of your customers and they say, and we always ask the questions, pretty basic, but it's, what if you didn't have this? And we want to hear them go, well, I'd be pissed, or, well, my boss would be mad, or we're going to lose money. We kind of try to hear those things. If we hear that, well, it's pretty cool, and we've been using a little bit, and we have some usage, some of our people are using it, most of them are not. We want to hear that. But we really want to hear customer love, because going to market today is the hardest part. A lot of companies, I'll just keep going for 1 second, Jason. A lot of companies, again, in B2B software, it's not really the tech, right? You're not like telling me you have 9 patents and that no one can own this technology. And it is really your ability to execute and create a passion for the team, because you're all starting a company with no money and you're not paying the engineers the highest price. You're not paying the head of sales the highest price. You're trying to convince them. So you have to have a passion and a vision that allows you to recruit your team, just the same passion and vision that you have to utilize to raise money from us. So hopefully that's
Great
helpful.
background. Jumped into a lot of the things that I know this group wants to hear and questions that I want to ask. I want to rewind you just a little bit and kind of zoom you out from the focus that you're in. You've done, you're focused on B2B software, but you as an angel, you as a lot of different things have backed successful founders in all different spaces and industries. And you talk about even your focus at the seed and how important it is for you to do the work, right? Because you're jumping into companies that even with a little bit of a revenue, like the future is not written for them. There's so much work that needs to be put into making a founder successful. What are some of the things, if you were to zoom out of the B2B focus, but just from a founder in particular, like what are the things that you look for or light your eyes up when you do your, I know you love just sitting down with a founder and just talking to them. What are some of the things that excite you when you come across them, characteristics, et cetera?
Yeah. Well, I'm actually older, which is not great, but I've been around, and I've lived in Europe for several years, and I've lived in New York and San Francisco and LA, and I grew up in Colorado. And I've had a chance to meet a lot of different people, entrepreneurs from different countries, different gender, different race, et cetera. Lots of different types of folks. And it's given me an appreciation for all the different types of people that can be successful if you're trying to start a company. There's no one stereotype, right? But what it also gives me the ability to do is to kind of try and create and get to know the founder a little bit better than that first half hour, because what happened over the last 3 years, which we've all heard about and maybe you experienced yourselves in this Zoom COVID-landia, was forget getting to fucking know you. Like, you got 30 minutes to do this over Zoom. I don't even care where you live. You could live in Pittsburgh or San Salvador. It doesn't matter, because we're all living in this Zoom land. And that really took away my comfort level and my skill set in terms of getting to know a founder and what drives that founder. And there's all different reasons. But for example, I appreciate everybody is educated in some ways, some more than others. Some went to better schools than others on paper. It doesn't matter. I don't care where you went to college, et cetera. I may ask where you went to college, so I can ask you about my experience having gone to that place for a meeting or a dinner sometime. It's just like, where'd you go to college? Well, I went to Texas A&M. Oh, I went to a game there in 2015. Remember that? And you just have a conversation. Like, you will not find me asking you within 5 minutes of having this conversation, okay, tell me about what the technology you built. Tell me your customer base. Who's your top engineer? I care totally, but I don't care for a while. So, and I'm just trying, what's that?
Yeah, go. Will you say 1 second?
Did you have a question?
No, I wanted to push you to give a little bit more detail around this, because whenever I bring a VC up, I always want this conversation to happen. And I will look in the audience, the Zoom audience, and kind of see a number of them being like, yeah, like, because you're talking about a soft skill, you're talking about a person-to-person connection. And these founders are all like, no, I'm building software for the airline. That can't be what he cares about. Tell us why this is important.
Yeah. So first of all, you've heard this before. We are going to be together for a long time. And the more successful you are, the longer we're together. Because, right, if the company doesn't pan out within 2 years, the company goes out of business. Doesn't mean, depending on how it went out of business and how our relationship was, that we're not going to continue. As a matter of fact, companies fail all the time, they either fail poorly or they fail well, and that depends on the founder. And so we have relationships with founders. Of course, I have relationships with founders for a long time who actually may have been one of our failures. And so that's because I get to try to know them as a person. And so what I'm trying to understand is really what drives you as a person. I love to find out, for example, I'll pick on two people right now, ready? Because I can see all your names. Faith Selby and Cameron Clouchy. I'd love to know where what actually drives you. Do you have a brother that was older who was very successful? Do you have a mom who built a company and you feel like you've got to try to beat her? And there's just little questions like that. Where, what's really driving you and how did you get into this? I think that a lot of people in today's environment have determined that being an entrepreneur is a job track. Like, for example, you can take an entrepreneur class in college. And I actually have taught it. And I always laugh at the end. I'm like, so are you all starting a company because I just taught you how to be an entrepreneur in an hour in a class? It just doesn't work. There has to be a drive and a passion that causes you to want to go through the pain and hassle of starting a company, right? And so that's why I try to find out. And I'm just trying to get to know you because we really are going to be spending a lot of time. And we always strive at Bonfire to be the first call, bad news and good news, right? And so we have to earn that from you. You don't work for us when we make an investment. We actually work for you. I know it sounds kind of like I'm switching around the words, but we don't work for you. We've invested in you. We're here to help. And we don't take the attitude that you're now part of our, that you work for us. And so we want to try to find that you have some skill sets that allow you to be a partner and that allow you for me to understand what is able to drive you to hire. If you go back to my first point earlier, how can you drive and hire this team you're going to hire and talk them into working for you? Because really you have very little to talk about. Of course, you might have a partner, so the two of you, let's just say, or the three of you that you founded the company. How are you going to convince somebody to take a job for $122,000 a year and 2 points of equity? And so you really have to have that skill set. I think that's important.
Cool. I'm glad we spent time on that. I in every variation of this workshop, like that is one of the most important things for founders to understand about is like their connection to their business, both for themselves and for when they're talking to investors like you. We don't have a ton of time. I did want to actually transition to some more kind of tactical, specific things about the industry in 2023, because there has been such a crazy reset, a bit of a lull in Q4 where people were just like on the sidelines, and now everyone's unsure of what's happening. And so whenever we have these opportunities to pull the curtain back and actually ask someone that's doing deals, even you don't know because one person isn't the market is everyone. But from your perspective and what you're seeing in deal flow and the deals that you are doing, we found that you've done, I think, at least 2 deals in 2023 already, which is amazing. What's your perspective on what startup investing is going to look like in 2023? And you can take that in a variety of directions, velocity, et cetera.
Yeah, just to confirm, we did 10 deals last year. We've signed 2 term sheets this year. Okay, so, and we'll expect to do 8 to 10, 8 to 12 deals again this year. What we do is a long-term business. I have companies like Scopely that I invested in 2011. We still own that position. It's now 12 years old, 13 years old almost. It's over $1 billion in revenues. So you have to think that this is a very long-term business and relationship, and therefore I can't time the markets, right? I can't, I could have never predicted COVID in the last 3 years. And so I don't try to. I don't know what's going to happen this year. Are we going into recession, what have you? But I do know that we need to keep focusing on, because there's going to be good and up and down markets, and you just don't know when. No one can tell me when. Hey, you know what? 2024 is going to be a great year. I already know it. And we won't know till 2034 if 2024 was a good year. But I know it's 2024, so I'm not going to invest any money this year. I'm going to wait till 2020. Bullshit, right? You've got to be in the market. And so while our timing goes up and down a little bit based on what is taking away our time, for example, given the environment, a lot of companies are a little bit stressed. And so we're spending more time with our portfolio companies. But we still need to have our eye on the ball in terms of opportunities. And the opportunities haven't gone away. So we're going to continue to do what we did. Interestingly, one of the advantages we have is that we lead seed rounds. A lot of seed investors out there. And when I first started my fund, I didn't lead any rounds either. I was participating and hoping to participate in rounds led by other people like Greg Croft. That's why I met Jason. And now we lead those deals. And so there are very few actual seed funds that lead deals and write those checks. A lot of people like to participate, and more so today. There were so many new seed funds started in the past who are smaller, which is fine, and great people, but they write $500,000 checks. So they're not able to drive the processes. They're not able to drive valuations like we are. We have played in this game of fluctuating valuations. And obviously there was this phrase founder friendly, and that was certainly the environment over the last 5 years. We are founder friendly. We're friendly to our founders. We work with our founders. We like to be with them, but we are also trying to make a return. And so being founder friendly doesn't mean just let everybody, let valuations walk all over you. And so we do see quite a bit of valuation resetting here, but really only back to, let's call it 2017 and 18. I can tell you some of the best companies we have now in our portfolio we invested in were sub $10 million valuations. And the seed rounds we used to lead in 2017 were like 2 million at 7 pre, 2 million at 6.5 pre, 2.5 million at 6.5 pre. Our average pre-money valuation was 7.1 in our first fund, 9.1 in our second, 13 million last fund, and it's going to go back down. So what happened was there was an acceptance by the market, all of us, investors and founders. We need more money to show growth. Why? Because it's so hard to hire people. Everything's so expensive. Google's taking my engineer and paying them $500,000 when I was going to pay them $120,000. It takes more money to buy a Facebook ad, a Google ad. It takes more money to buy customers. Your customer acquisition cost has gone up. Yes, true. And therefore there was a forcing function that instead of raising a $2.5 million seed round, everybody was doing $4 million seed round. And in order to do a $4 million seed round and not give up more equity, you just raise the valuation, right? So if I did a $2 million at 8 free, so I own 20% of the company, if you understand the post, I own 2 million of the 10 million post. And then the founder goes, we need more runway and it's more expensive. So we need to raise 4, but I only want to sell 20% of the company. So my pre-money is now 16, if you follow me. And I used to get so mad at this. I'm like, wait, your company just went up in value, like double, just because you decided to raise more money, not because you're better at what you do or more efficient. And that's starting to come back down. I would love for founders to be much more focused on being much more efficient and getting to customer satisfaction with less money rather than more. And I will tell you, as a founder who has the most to win here, because you are the largest shareholder, the more efficient you are with your capital, the better it is for you. It's not a thing for me. I'm secondary, yes, but it's better for you. Now, I have a great story. I was contacted a year ago by a guy who I met in 2013. And he said, hey, this is so-and-so. We met back in 2013. I'm like, yeah, how are you doing? Nice to hear from you again. He goes, you know what I did? I'm like, no. And he's like, well, I ended up building this company, and he had changed the name of the company. That company ended up being acquired for over $1 billion by a private equity firm. And then the private equity firm took it public. So he got like a double all the way. I'm like, I didn't know that was your company. He's like, yeah, and he was very, very humble about it. And I said, well, what are you up to? And he goes, I'd love to have breakfast with you or lunch. Let's just get together. So we go and get together, and he brings a napkin with him that I had written on in the first meeting we had. I obviously turned him down on the investment, right? So he sits there, goes through his plan, and I clearly said something like, it's not for us, and here's why. But here's what I think you need to focus on. And I made this chart of what he needed to do, and he kept it. And one thing I told him apparently, which I don't remember, was don't raise venture capital. You don't need to. Not every company is venture capital backable or should be. As a matter of fact, very few companies are. Most companies are built to make money because that's your livelihood. They don't need to be built just because you think it's cool to build a company. And so he ends up going out and not raising any money. And he grinds away and makes it profitable by building a company based on revenue that was the revenue coming in, was paying for expenses to grow the company. And he ends up becoming about a $400 million heir. He now is an advisor to my portfolio because he wants to get back in the game and be a coach. And he came to me because I'd given him that advice. Now, of course, I was mad. I gave him that advice. Why didn't you talk me into giving you money? So I'm just kind of jumping off target there, but there needs to be a focus on, does this need to be a venture-backed company that I'm starting? Do I need to go through that process of selling equity in this company, and then now having somebody on my board, helping guide me, but also telling me what to do? Can I build this as far as I can go without ever raising money, or just a smaller amount of money? The more efficient and better you can be with using capital, the better it's going to be for you as the owner.
Awesome. And I'd just like to point out that Mark and I had the shortest conversation about what this would be. I gave him no context for what I would be talking about. But just so you know, Mark, in the first 30 minutes, half of about 20 minutes was spent talking about this subject that you're uncovering, which is like not every company needs to or should be a VC-backed company. And there is no positive or negative association with not being VC-backed.
Yes.
We ran you
actually, to be honest, when you're at the end and you say, I didn't even, when you sell your company, I'm like, I didn't even raise any money. VC.
Yeah,
that's
the coolest badge of honor, right?
Yeah.
Amazing. Look, we are right at the hour. I think we wanted to see if there was time for questions. I don't think we have it this time, but Mark Mullen is active on social. He's got a great presence. And is an investor that you'll want to build a relationship with if you ever think that venture capital for your SaaS B2B company is something you want to pursue in the future.
Jason, before you leave, a bunch of people are sending me chat questions, which I can't answer right now because there's too many, but are you going to send them to me? Can you get those?
Yeah. What I'll do is I'll have the list of people that attended. I'll take down the chat and we'll do something where Mark can efficiently give thoughts around your questions. Okay.
Yeah. Okay, everybody. Good luck. How many people are here?
We had, I think, 100 at some point. We're down to 64 at the very end, but appreciate everyone. This is great.
All right. See you, everybody.
Yep.